and welcome back to MoneyWise UK podcast. This is the show where we explore ideas, strategies, and people shaping the future of investing and financial planning. Now, today, I'm hoping that we're going to be doing something a little bit different. Following kind of a recent conversation that I had with our guest, we're diving into a topic that doesn't always get the spotlight that I feel it deserves. And it's about diversification. And the question is, at what point does diversification become over-diversification? So I'm really delighted to have Damian Bird, who's a portfolio manager at Polen Capital, and he leads their emerging markets growth strategy. Now, we're going to kick off, as we always do, with some quick-fire questions, kind of to get to know Damian just a little bit better. And then we're going to dig into diversification. We're going to talk about emerging markets. And we're also going to talk about the approach to Poland as well. So it gives them a chance a little bit to talk about what they're doing. So first of all, welcome, Damian. Thank you for joining us.
Thanks, George. Good to see you again. Last time we spoke, it was absolutely pouring down in Bristol earlier in the year. So still the back end of summer, but nice that the weather's a bit more favourable now nowadays.
Yeah. Well, we've had summer, so and that's ended, and we've got rain again. So perhaps you always bring rain.
Yeah.
So let's start with let's start with an easy question. Who has inspired you most in your career, or perhaps in life more broadly?
All right. Well, first of all, George, I have to call you up on that. That is not in any way an easy question. Anyone that's been asked that goes, "Oh my goodness, who's inspired me?" Look, obviously we're inspired by a lot of people. I think if I reflect on this question, I think the answer has to be, for anyone, it has to be some of the great people over the past, right? You know, people like Isaac Newton, who solved the laws of the universe, or Charles Darwin, who kind of solved how we all came to be here. These are enormous achievements, and I'm massively inspired by those guys. It's always, I suppose, the intellectual achievements that I find most inspiring over and above, let's say, David Beckham's last-minute free kick against Greece, which I did enjoy very much as well at the time. But I think maybe just for the purpose of the podcast, I'll give an example of something that's closer to home in my life that I thought was really interesting. So I've always worked my whole career in emerging markets, and I began my career at a company called Aristec Partners out in Asia. And I worked with a partner there called Lindsay Cooper. And I remember working with him in 2009. So it was kind of back end of 2008, early 2009. And there was a little bit of reflection going on about, obviously, the journey that investors had over the time. And so, this was, emerging markets got absolutely whacked during the financial crisis. And the firm was very much a client-first business. And the company was looking at performance and seeing that the fund was down, I can't remember exactly what the numbers were, 30, 40% over that period. It's very interesting kind of reflecting on how the business thought about that then versus how they thought about that now. Because whilst the fund was down 40%, the market was down way more. So the modern day investment firm would look at that and go, that was a great year because we outperformed the market by 20 or 30%. And the way the company at the time thought about it, oh my God, this is a terrible year. We've lost our clients 35 to 40% of their money. So yeah, I mean, that type of integrity and client-first mentality has kind of been brought into how I've always thought about investing at the time. But anyway, because we had lost our clients a decent amount of money over that period, as I said, there was lots of introspection, lots of thinking about, okay, what could we have done better? And I remember doing some work for the partner at the time, who, as I said, was a Scottish investor who I respect very much, called Lindsay Cooper. And he said to me, all right, Damian, let's get back and look at our portfolio from 10 years ago. And how was my Asia, it was actually an Asia fund. How was my Asia fund positioned in 1998 or 1999? And then he said, all right, can you go back and get the data and then work out what if I had absolutely done nothing to that portfolio? Imagine my investment philosophy was play golf for 10 years. That's my investment philosophy. And we're going to leave the portfolio as it was until now. how would I have done? Anyway, so I went back, got the numbers for him and came back and said to him, hi Lindsay, so I've got the results. The good news is, well, there isn't really any good news. The good news is you would have made absolutely enormous amounts of money. The bad news is all the changes that you made to the portfolio over that period of time actually detracted from what would have happened if you had done nothing. So actually the playing golf for 10 years investment philosophy basically would have been the greatest investment philosophy of all time. Not quite of all time, but it was something like 30% compound returns, for 10 years in that fund. That's the fund which has done very well. I mean, I don't want to underplay how well experienced investors did, because they did incredibly well. They did something like 15% compound over that period. So it was a great time to be invested with us at Arasay. But it was just a lesson that if we'd done nothing, it would have done even better. And the reason why I was sort of inspired by Lindsay is the way he took that on board and just really embraced this idea of humility in investments. And there's I think as an investor, we always think that we can add value. Every day we come in, I mean, like I've even done it this morning. I've come in, this market's down, like Indonesia has been down the last few days, and then today it's kind of rallied a bit. And there's always a temptation to get involved in your portfolio. And I think to be very, very active on a daily basis and add a bit here and remove a bit here, or, maybe actually this company's a bit better than that company and let's switch them out, and to be very active. And I think that lesson that I've taken with me from 2008-9, is just to appreciate that we don't always know, right? Sometimes actually understanding that you don't know is one of the best investment decisions that you can make. And realizing that the way I interpret it these days, I call it fiddling. And we try and really only make changes to the portfolio when we're really sure and when we're going to make meaningful changes. So I don't really believe in the kind of 10 basis points here, 20 basis points here type changes, because I don't really think they move the needle. And so what we try and do when we're managing money here at Polen is try and make meaningful changes to the portfolio. A whole company in, 2 or 3% of the fund in, 2 or 3% of the fund out. Adding to a name, adding 1.5% of the portfolio to a name. And only really when we're very sure. So we run low turnover portfolios, and it all really comes from this idea that we're conscious that what we don't know is so much more than what we do know. And that it's very easy to destroy value by acting on something that you don't know when you think you do.
And it's interesting because there's other questions I want to ask within your quick fire, but I want to pick up. It's probably the wrong time to ask this, but I'm going to ask this question.
Let's do it.
I'll probably go back to those questions in a minute. But I'm going to jump straight into kind of this idea of diversification. And I will come back to questions around a surprising fact about you and a book and stuff. You just have to wait until
we'll do that. Yeah, towards the end.
I'll throw that one in. But it's interesting because of what you're saying, and that kind of, I guess what I'm thinking of is I've come across funds where, they've had 100 names. And I remember looking at one of these funds, and 30% of those names had less than 0.5 allocated to them. And the reason behind that was that the fund manager didn't know. They felt they were in the right sector, but they didn't know who were going to be the leaders from there. And I think that kind of goes on into this question about diversification. And obviously we're talking about emerging markets. And I guess what sparked my interest when we spoke was that this idea that diversification beyond a certain number starts to sort of diminish. And I know you've talked about 16 to 17 names as the point where risks are effectively spread. Now, in fact, I had a conversation with someone yesterday about this, and they're very their idea is if you've got 10,000 names, then it's the best form of diversification. Sure. You said 16 to 17. So it'd be interesting to I wasn't able to really argue it. I just went, yeah. So it'd be interesting to get your thoughts around that.
Okay. All right. So let's sort of start at the beginning. So the numbers that you're referencing this is coming back from the science of investing, that was very popular in the university circles 40, 50 years ago. The same type of time that people were coming up with the efficient market hypothesis and similar theories. And there was a paper by Evans and Archer in 1968, where they basically looked at diversification benefits of different securities. And what they found, and this kind of ran various different mathematical, what do they call them now? Regressions. And they said that if we took, in the US market, if they took a random collection of 10 to, they tried it with a random collection of 2 companies, a random collection of 10, a random collection of 15, a random collection of 50, a random collection of 100. And what they found was that you actually only needed sort of around 10 to 15 names to really reduce the expected and the experienced volatility of a portfolio of an equally balanced group of those names. And how they judge volatility was the kind of standard deviation of the journey. So that was and that reduces, obviously it doesn't reduce it to 0, right? But it reduces it to a level where, there's no hard line, but it basically reduces it to a level where the standard deviation is more or less in line with what the quote unquote market delivers. This paper was done in 1968, right? So this would have been 15 random companies will deliver objectively over time and expected the same level of standard deviation as the S&P 500, basically. So what we did when we were looking at this is we went back and looked and did the same study, but based on emerging markets. And the thing about emerging markets is that we're not just investing in the US, we're investing in China, we're investing in India, we're investing in Brazil, we're investing in Poland, we're investing in Vietnam. And so there's a bit more variance that comes with, can I say, the average stock. But so we need a few more in EM. But what our kind of regression analysis showed was that you really only need somewhere between 15, 16, 17 of random securities. So there's in the EM index, there's 1,000 names or whatever, right? So you pick at random 15 of them. That should get you the similar level of standard deviation experience as the market, basically, or somewhere in the region that you're comfortable with. The problem with 15 or 16 in terms of a portfolio that diversifies risk away is that when we go managing portfolios, we don't select 15 stocks at random, right? And they're not completely uncorrelated. And so when we're thinking about what sort of standard deviation experience our portfolio will have of a portfolio of 15 names, like if you pick 15 names in our fund, they're going to somewhat be correlated, right? So we own, for example, 2 names in Taiwan. We own Taiwan Semiconductors and we own a company called Capit, both of which are in some respects part of the AI story because they both make critical components that are part of this data center build out around the world. So those shares, they kind of move a little bit together. And then we have other cases where we own companies that are also correlated. So within China, we own the leading manufacturer of electronic batteries around the world in a company called CATL. And we also own what is now the leading electronic vehicle company in the world, which is a company called BYD. And those guys kind of move together. They're not completely uncorrelated because ultimately the end demand of electronic vehicles, whether it be just for BYD cars or for the whole industry, affects both companies in a kind of similar way. So if you are just literally going into the market and going, all right, here's 17 random companies, our math shows that you can get an acceptable level of risk where you're not taking on higher than expected standard deviation than what the market will give you. Because we're picking names that by definition of our process tend to be kind of not clustered, but it's be unusual for each company to be completely independent of each other. We feel like you need a high number of names to achieve that level of diversification. Now, the other side of that argument, which is less about the kind of maths of standard deviation, is just about the principle of, I think what we say when we speak to clients is we'd like to own the best 30 ideas that we can find in emerging markets, not the next best 30 ideas. So theoretically, idea number 45 is not as good as idea number 15. So we'd rather take the capital from number 45 and give more to number 15, which is kind of how we think about it. A smart investor or a smart prospect or client on the other side of the table says, all right, well, wouldn't you rather have a portfolio of the next, why wouldn't you just have 20 and then the top 20 and the next 20 to 30 and take the money from that and put it in the top 20? And then the next person says, well, yeah, you got 20, but why don't you put them in the top 10 ideas? And then you end up with 10. And then someone says, look, you guys are really, really smart. Why don't you just pick what you think is going to be the best performing stock in the whole of emerging markets and only own that as one investment? And when you think about it like that, you kind of appreciate that the problem one's dealing with when we're looking at the opportunity set is we just don't know. Of course we don't know what the best. I mean, I'd say it's basically impossible. There are thousands of companies across emerging markets. Knowing which one on any time frame is going to be the top performing name is completely impossible. So I think what we're trying to do is strike a balance between, we work really hard on our process to identify what we believe are the most competitively advantaged businesses that we can find in our universe, with strong cash flows, great management teams, with huge runways for growth, with very, very strong balance sheets and total masters of their own destiny, that have consistently grown their kind of their value creation, their cash flows, their profits, their revenues in the region of 20 or so %. And we think can continue to do that for a long time going forward. We don't know for sure exactly how everything is going to go. So because we don't know for sure, we want to invest in a broader range of companies to give a little bit of comfort around that area. But then we also don't want to allocate capital to ideas that aren't as good as the best ones. So there is no mathematical perfect answer to this question. What we're trying to do is find a sweet spot between all the hard work we do to find what we think are the best ideas, the understanding that there's inherently an element of I don't know everything, and also the mathematics of what do we need to give investors a diversified experience given that some of our names are correlated. And those three factors kind of end up in the kind of 30 to 35 type range that we find.
So that's quite interesting because in fact you kind of covered two questions in one, which is really good, because I was kind of thinking, well, if I guess the point that you just made was like, well, if you're saying 17, why do you have 30? And I think you answered that really well. But I guess on the other side, I can flip this a little bit and play devil's advocate. And I'm going to wrap two questions into this because I think they both interlink. So kind of the first one is that surely if you can't find, if you don't know, because the argument is, like, if you're an active fund manager, I'm paying you to find the very best companies and do the very best. Now, if you can't do that, then you come into the kind of argument is that, isn't it safer, particularly in EM, to just go for the index? Because, given the volatility, geopolitical tensions that we often associate, surely it's safer. And then kind of interlinked with that, it's that we know, and please, anyone listening to this, I am being slightly cynical on this. We know that developed markets they have stronger legal systems, better infrastructure, political stability, and emerging markets can include countries at war, unstable governments. Given all of that, surely it's easier to just go index.
Okay, well, there's 2 points in there, Joy. I'm going to take them one by one, right? So the second one, which is the emerging market opportunity set and risk framework versus the rich world. I have quite a few opinions on that, and we'll do that in a moment. But first, the point about indexation and whether or not that can make sense for investors. The thing about indexes is they give you exposure to the average company by definition, right? I don't mean average as in middle of the road, but I mean a collection of thousands of companies, or in the US's case, 500 companies. You get a little bit of exposure to all of them, right? And I think the reason to do that in the US market, where there are more than 500 outstanding companies, without any question. The quality and depth of the US market is without parallel and totally unquestioned. And I think it's a very, very hard job in America to say company A is a better company than company B, and that the prospects for company A are significantly greater than the prospects for company B, because the gap between them is very, very narrow. I think the job is difficult if you're trying to do that. So I can see how some people would say, oh, it doesn't make sense to buy the S&P 500. Now, at Polen Capital, we have a US equity fund that has proven over a long period of time that by thoughtful stock selection, it is possible to deliver greater returns than the market. And we have proven that for our clients over a long period of time. But it's a very difficult job. In emerging markets, the situation is very different. In EM, the gap between what are the very best companies and the average company is enormous. Enormous. So one of the things that I think makes emerging markets so interesting at the moment is that I mentioned before that, in the S&P 500, you've got 500 truly great companies. That's probably a bit generous, but there's probably a lot of really great companies in there. I would argue that there's a good number of emerging market companies that belong in the list of the top 500 companies in the world. I would argue there's a good number of emerging market companies that belong in the top 100 companies in the world. In fact, I would argue that there's a good number of emerging market companies that belong in the top 20 companies in the world. And they're relatively new, and they're really exciting businesses. So I mentioned before Taiwan Semiconductor, that more or less monopolistic manufacturer of the highest, the most efficient and highest functioning semiconductor chips in the world. Absolutely critical to so much of what everyone does in their daily lives, and critical, particularly at the moment, in any kind of high-end AI analysis. Also, I mentioned before BYD, which is the leading electronic vehicle company in the world. It just surpassed Tesla in terms of total number of electronic vehicle sales around the world. There's a company in Latin America called Mercado Libre, which has a very good claim to probably being the second best e-commerce company in the world. And another company that would be challenging that claim would probably be Pinduoduo, which has come out of China, which also would probably be claiming to be right up there in the leading e-commerce companies in the world. And then some of the most attractive fintechs in the world are coming out of emerging markets. So there's a company in Brazil called Nubank, which is kind of proving itself as the most innovative, dynamic, fast-growing and profitable digital bank in the world. And then if we go and look at the AI supply chain I mentioned earlier, there are so many companies in Taiwan and in South Korea that make components that are absolutely critical for everything that these hyperscalers in the world are using. And so I think when people invested in emerging markets 10, 15, and 20 years ago, there was a story about there's 6-7 billion people living in emerging markets. They're all getting richer over time. They're going to spend more money on washing up liquid and more money on noodles and more money on cans of Coke. And I think that has been true, but it was kind of all about companies in emerging markets who were mimicking their Western peers, like company that was trying to be the Nestle of country A, or trying to be the Coca-Cola of country B, or the Procter and Gamble of country C. And they were just kind of poor imitations. And now we're seeing companies in emerging markets that don't even have peers, that are themselves the leading in the world coming out of EM. So the story of emerging markets has changed. And there is a group of really, really best-in-class businesses that we think are very, very interesting and are far superior investments to the average business that one finds in emerging markets. If you buy an index, you're buying 1,000 companies, right? If you buy an actively managed fund, by ourselves or some of our very competitive peers out there. You're buying some of the best companies you can find in emerging markets. And why we are very excited about the asset class at the moment is that the price one is paying for the very best companies in emerging markets, one, relative to the rest of the emerging market asset class, it's very, very low. Before, you had to pay a big premium for the best company. At the moment, any investor can pay a pretty small premium for the very best companies. And two, as I mentioned before, there are a number of names that we think belong in the list of the best companies in the world. The ones that trade in emerging markets trade at very, very attractive valuations. The ones that trade in the rich world trade at the higher end of their historic multiple. The ones in EM trade at the lower end of their historic multiple. So for this reason, we think in EM, we don't think passive is the way to go. We think an active approach is the best way to get a select exposure to the very, very best companies. So I would always encourage listeners to think about active managers. And then you kind of teed me up to say, well, emerging markets have got all this risk and there's wars and all this sort of stuff going on. The emerging markets have been out of favour for a while now. And there's been a idea in the market that because the performance of the asset class has kind of gone sideways for a few years now, that in EM, you're getting all of the risk and none of the return. Whereas investing in the US markets, you get all of the return and none of the risk. And investors have looked at this and go, well, okay, I prefer the second option. That sounds better risk return dynamic to me. And what's happening in the last 12 months is people are starting to question that a little bit. They're starting to look at macroeconomic policy coming out of the US, starting to look at tariff policy, which is typically something that you would associate with poorer performing EM countries. You're starting to look at deficits, which to use other people's words are starting to get out of control. In many rich economies, you're starting to look at fiscal national balance sheets, in terms of government balance sheets, which are really at the upper end of debt to GDP. And you're probably starting to look at a little bit more, frankly, you're looking a little bit more geopolitical tension in many of these countries. Arming is going up across the rich world at the moment. And valuations are very, very high in rich countries. And then if you contrast that with the emerging market world, you've actually seen fairly rational monetary policy in many emerging markets. Not all of them, because I will say that there remain many that are highly challenged, places like Turkey or Argentina or Pakistan and countries like that. But some of the most attractive ones have got very, very rational monetary policy. They've got fiscal situations that are lower than they have been on average and have been coming down. And they're seeing strong fundamental economic growth going on in their markets. And the valuations are trading at record lows. So I think objectively, someone that looks at the EM asset class right now and thinks about what can one reasonably expect from emerging markets going forward, there's lots of reason to expect emerging markets to do very well. Fundamentally, the growth is really very, very strong. GDP growth is continuing. There remains this huge number of people. That story about 80%-ish of the world's population living in emerging markets remains true. Purchasing power is going up. You're seeing the currencies increase in value. And you're seeing corporate businesses in these countries delivering outstanding results. So I mentioned before our portfolio. We think our companies, on average, over the last 5 years, have compounded their earnings per share at 18% a year for the last 5 years. But we have to make some assumptions and some complicated spreadsheets to try and work this out. But it's our best estimate, our fair assumption of what the portfolio has done. And at the moment, looking at the first half numbers that have come in, it's actually growing faster now than it has historically. So we're now pushing the kind of low 20% earnings per share growth for the portfolio. But over that 5 years, our fund has more or less moved sideways. it's gone up a little bit. The investors have had a reasonable return, but most of the earnings growth has been lost to multiple compression. But what that now means is that the portfolio is trading on more or less the lowest it's ever done. Like, our fund is actually having a very good year. It's up more than 20% so far this year. But because the earnings growth is coming through so strong, it's actually not even getting more expensive. It's kind of holding its cheap valuation. So what we think, we never expect returns, but what we think there's a reasonable chance of happening is that these companies will continue to deliver this kind of 20-ish% compound growth they've been delivering. And as base case, hold their valuation, which for the portfolio is around 16 to 17 times earnings. That would mean that investors should expect to receive somewhere in the region of whatever the earnings growth is. So let's say it's 18%, that would be 18% portfolio return. If you saw a weakening of the dollar, that would actually increase those returns. And if you saw an increase in valuations, which are coming off a record low trough, that would also increase those returns. So we never know exactly what will happen. Obviously, past performance is never indicative of future returns. But we think if you were to objectively look at the universe as it sits, go look at kind of more or less any manager that manages money with a qualities bias towards trying to find the best companies you can in emerging markets. Right now, there's a really attractive opportunity to buy some of the best businesses in the world at a significant discount to how they would trade if they were trading in some of the more developed markets, at a significant discount to where they have historically over their history, and at a time where we're starting to see earnings accelerate and investors really consider their allocations to emerging markets. Because at the moment, so few managers, so few allocators are actually invested in EM. So we think if these people that use the MSCI World as their benchmark, maybe something like 5 to 6% is the average exposure to emerging markets, and something like 70% to the US. It really wouldn't be a big change to see 2% allocations come out of America. And if that 2% came out, we would suggest emerging markets would be a very, very likely destination for that money. And that could be a meaningful catalyst for the asset class going forward.
I'm going to ask, well, I've got two questions, and one again is it's a bit of a negative one, and then I'm going to give you a positive one to work on. So I get all of that. I get the argument. I get that you're looking at some of the best businesses in the world, and you know, maybe our view of countries, they differ. You know, every country is different. But another kind of counter to it is, and maybe that's to some extent has come from China, I don't know, but there's this argument that they don't follow necessarily a Western way. I'm not saying that's right or wrong, but sometimes they don't. So they have these kind of complex company structures, limited transparency, you've got the kind of local nuances. And, you know, these might be the best businesses in the world, but can you really understand these businesses? And how do you get that conviction? Because surely it's just like smoke and mirrors, you know, you don't really know what you're investing in.
Yeah, well, I think the answer is, George, that the type of companies that you are referring to are the type of companies that I also refer to when I say, don't just buy a little bit of everything in emerging markets. Because it is without question true that in different markets, there are different nuances in certain companies that make them difficult to hit the governance standards that we would expect. So in some countries like South Korea, there are kind of legacy issues with big, they're called chaebols, but they're big kind of institutional conglomerate businesses with lots of subsidiaries that all have complicated interconnected ownerships of each other that deal with each other, and historically haven't delivered great returns for their investors because minorities haven't necessarily participated in the strong success of the business. In other parts of the market, like an obvious one is China, there's a huge number of state-owned businesses. And whilst it's possible to be a state-owned business and be well run and to also look after the interests of minorities, on average, that's not normally the case, because the businesses have other objectives, like trying to hit whatever kind of national need objective is at the moment. So we would never invest in really the state-owned financial sector in China, because we think it is, as you mentioned, opaque, and it is challenging to really know what you're investing in. And it isn't, perhaps a little bit unsure exactly what the objectives of the business are. And in other countries, there are family ownership. So in India, it's very common to have family ownership structures. And sometimes there are businesses that are not owned, or that are owned by the family, but not owned by the listed company that do business with the listed company. And then you're not quite sure what the terms are of that those business dealings, and as minorities, how comfortable you can be about whether or not you are participating equally in the success of the company. So these nuances exist across emerging markets. And that's why I think for active investors, it's very important to look at all these areas and think very, very hard about whether minorities are truly participating in the strength of the company. But I do think this story is changing, and I think it's less of a thing than it has been maybe 10 years ago, because the average company in emerging markets is getting much better. Basically, these type of companies with the issues that you mentioned tend not to do very well. So on average, they get overtaken by companies that tend to do better. And what's happened over the last 10 to 15 years is they have kind of been overtaken by companies that have done a bit better. So the average company has got better in emerging markets. But I still think there's a big spread between the really, really good companies and the quite good companies, and then the ones where you're not totally sure where you're getting the equal minority participation. So again, to me, it's an argument to be active when you're looking at the asset class. But I sometimes get asked questions, oh, surely the companies don't pay dividend. Absolutely. The companies we invest in pay dividends. Some of them, particularly in China, there are huge dividend payouts. There are massive share buyback programs going on. We own a good number of companies in our portfolio where the shareholder return in the last few years has really pushed up to 10% annually, like a year, in terms of a combination between buybacks and dividends. So corporate governance standards vary, but when they're good, they are really very good.
Can I ask you then? Okay, so I get your arguments for why, but then we've got another issue, which kind of you've alluded to. Last 15 years, if I put my money in the US, I've got, I don't know what the returns are, I don't know, 10, 20% a year.
I think 15 nearly annualized in the S&P over 15 years. It's been amazing.
So why, I mean, you can't tell me that those top 7 companies are not going to give me the same over the next 10, 15 years. I mean, it'd be very hard for you to do that. And so why?
Let me jump in.
No. Why? I mean, I might as well just bung it in there and just not bother with emerging markets.
All right.
Actually, that was quite a negative one. Sorry, I said this was a positive.
Oh, I don't mind. I mean, look. I mean, will the Magnificent Seven keep delivering that? I think there's some people who believe that, but there's a lot of people who believe that won't be the case. Like, I don't follow those companies and closely. Obviously, we follow them just as a market participant. But I think there are question marks as to the long-term success. I mean, it would be incredibly unlikely if you go back and look at time and you look at the 10 or the 5 largest companies in any market and fast forward 10 years, it's incredibly unlikely. It'd be incredible. It's basically never happened. There's always something that changes in one of the companies or a new business that comes up. I mean, even Nvidia being in this list of Magnificent Seven. I mean, what were we? We were FANGs, 5 years ago, and the N wasn't Nvidia, it was Netflix. Right. So the companies come and go, and yes, some of the biggest and best companies in the world are doing very well right now, and I'm sure many of them can be good investments. But back to what we said right at the beginning, I think investors need to think about a diversified portfolio. And there is a chance that the US dollar relative to other currencies around the world is going to underperform as an asset class. Most of these companies earn a majority of their revenues in US dollars. So if global investors, or any, depending on where people are listening to this, if you're an allocator looking at your portfolio and you're using MSCI World as your benchmark, and you've got 70% in the US, we're not saying don't have anything in the US because they're not going to do well. But are you really betting, if you think about having 7% in EM and 70% in America, is that the right allocation, given where valuations are in the rich world, given where valuations are in emerging markets, given the long-term structural growth you are seeing in emerging markets, given the balance sheet of some of the developed market governments, given the challenges we're seeing with potential monetary policy issues coming forward, given rising geopolitical tensions, given potential weakness in the US dollar, does it really make sense to have 10 times more allocated? And that's, by the way, for people that have a lot in here. Some people have got 3 in here. So for those people, does it really make sense to have 20 times more in America, a country with 350 or so million people, versus the rest of the emerging markets with roughly 6 billion people, and with strong fundamental growth and some of the best companies in the world trading at discounted valuations? Is that the right allocation? Maybe it's 10 and 60. If you look at my portfolio, George, it's 0 in America and about 75 to 80 in emerging markets, because that's where I see so much of the opportunity. And the rest, by the way, listener, is in bullion. But yeah, who knows? I might not be right with my allocation, but it's possible. And it may be that, you know, the MSCI World with 70% US and 5% EM also is also not right. Perhaps somewhere in the middle would be an appropriate allocation. I mean, I think the opportunity for allocators right now is when you hear people like myself who've looked at emerging markets for a long period of time, and we are saying, honestly, we've never seen the asset class look like this. We've never seen the quality of businesses in the asset class. We've rarely seen the growth so strong. We've basically never seen the valuation so low outside of a crisis. And we've certainly never seen them so low relative to the rich world. And yet nobody's allocated. So if I'm an allocator, I'm thinking, yes, I can go with the crowd and I can have the same exposure as everyone else, and I can have 75% in the US. But if I want to be really successful at my job, the opportunities that I'm really looking for are ones where the fundamentals completely stack up, where all the homework I do says, oh yeah, the fundamentals are great, the growth is really strong. Oh yeah, there's amazing loads of really, really good companies. Oh wow, yeah, the valuations are really cheap relative to history and relative to the global market. I think that's the perfect cocktail you're looking for. If you want to be different, what more do you want? The only thing that's missing in that, George, perhaps is momentum. Momentum has become a big thing in investing. I'm here to say momentum in emerging markets has not been our friend for a long time until now, where we're finally starting to see year to date, emerging markets are up over 20%. The Western markets, US markets are up 10. On a longer term horizon, over a year, the emerging markets are winning. China is actually winning. China's been a much better place to have your money than the US now for, I think, nearly 18 months. And people are starting to look at their allocations thinking, maybe I should have something in emerging markets. But people haven't made that change yet. So people can be early now. And the thing is, if the money does start to come, it has the potential to be self-fulfilling, because the capital comes in, that raises valuations, that raises performance, people notice, more people think, yeah, maybe actually I should be invested in emerging markets. And they come in and it starts to get going. I feel like we're in the early stage of that story. as someone who's in the business of running portfolios for investors, and I guess it's in my interest for the asset class to grow. I feel like for the first time we're starting to see investor interest pick up, and I am really confident about the prospects for our business, but also many of our peers who've had a tough time in the last 5 years.
So that's a really nice way to kind of bring this bit about diversification to an end, because I think the way we've traveled is fascinating, because we've started with this idea of almost like building a fund of small number of names. We talked about the idea of getting that kind of sweet spot, where index works, where index is harder to beat, and where the opportunities kind of sit within that. We've also kind of challenged this idea of developed versus emerging. And I think also, like, at the end, where we've talked about that real difficult mindset of the last 15 years, you've done really, really well in the US. Do I want to give that up? And I would say to listeners, having a strategy of 70% emerging markets, and, maybe that doesn't give diversification, but it does to some extent, because even within that, it is high risk. But within that, you're going to have different companies. What I kind of want to sort of switch into a little bit, and we've talked actually quite a lot about Polen throughout this. It's kind of come through this, but I'm going to give you some quick fire questions. Okay, so you've got to answer these in, like, let's say 2 minutes. I'm going to start on one that isn't about Polen. Okay. This is about you. So, okay, so if you weren't in fund management, what would you be doing today?
Oh goodness, I don't know. I mean, I actually tried not to be in fund management when I started my career. So I went to university, and my father worked as an investment banker in the city. And I'd seen a lot of my peers were going off to work in the city as well. And, it's a bit boring. Let me try and explore other career opportunities. So I actually went and worked in advertising for a year as an account executive, which I quite enjoyed, working in Soho in London and making adverts and going to TV studios and voiceover recordings and things like that. But I felt like I wasn't quite using my brain enough. And then I decided to move to Paris, where I toyed with being a sports journalist, because sports is definitely one of my real passions. But to be honest, I don't like writing enough. So that made journalism a terrible choice of career for me. So yeah, I found my passion for investing a little bit later than some people. I wasn't, for example, at university in the investment club, which, by the way, if there are young listeners who are thinking about getting into a career investing, I think that is a great way in, because it kind of immerses you much earlier in the industry than I was. But yeah, I kind of came about it in a roundabout way. But now I'm in it. I'm absolutely delighted. I love my job, George. It is great. It is so interesting. We get to, we obviously take the responsibility of managing our clients' money very, very seriously. And we like to think very, very hard about investing thoughtfully and never, ever, ever speculate. Always long-term, careful investing. And the heart of it, it's just going out to all these countries that we've been talking about and meeting companies in these markets. And it's fascinating meeting different business leaders. I've become, I think, quite knowledgeable about quite a lot of different industries. And it's very broad, the exposure you get. And it is fascinating. And sometimes, those of us that work in finance, we think, well, it's a bit, what are you really doing when you're older, and you think, okay, what have I accomplished in my life, whatever. And wouldn't I rather been a doctor or I don't know, or Charles Darwin or Isaac Newton or something, as we talked about before. But there's something quite fulfilling about the job in emerging markets of essentially providing capital to some of these parts of the world that have less capital than, say, we do over here, and enabling these businesses with that money to grow and develop and to prosper and to become more successful and create new jobs and create opportunities for these billions of people that live in these countries. And even when you visit some of these markets, it's amazing. Singapore stands out. I actually used to live there for a while when we first started my career. But I mentioned before, right at the beginning, doing that work about the playing golf for 10 years investment philosophy, which is a good one. That was in Singapore. And that was in 2008-9. And honestly, if you go back now, oh my goodness, it's different. Like they had 3 metro lines then. When I last went last year, they had 6. I was going to say they still have 6, but I actually don't know. They might even have 7 by now. They pop up. I live in London. I mean, how long would the Elizabeth line take? 20, 30 years? It would take forever to do 3 new tube lines in London. The skyline's completely changed. The harbour has completely changed. The sea has moved in Singapore. The sea has moved. They've pushed the sea out and they've closed off one of the harbours to create a little marina away from the sea. And it's true in other parts of the world. India is rewarding to go to. You get to see the development of the Indian economy. Go to Bombay or go to Delhi. And the changes that's happening there, or go to Bangalore, as I call it, or I can't remember the modern name for Bangalore. But yeah, go down there and yeah, the development of the tech sector down there is phenomenal. Or Poland, here's another example. Poland, right? I went to Poland for the first time in 2009. Poland, by the way, is a significantly underappreciated emerging market. There's a lot of very, very interesting companies there. I went to Poland in 2009 for the first time. We just came back a couple of weeks ago from a trip to Poland. It's amazing what's happened to Poland. I mean, Poland now feels like Germany. It's so prosperous. It's everything works. It feels happy. The companies you meet are incredibly high standards. So it's kind of really rewarding seeing all these journeys going on in front of your eyes. And I guess what's next? Vietnam. I think Vietnam's going to be the next one where you really see visible change in the economy, because that market's growing very, very fast.
Okay, so we went over the 2 minutes there, but that's
okay. Sorry, let me quick fire.
Okay, now this is let's try for a minute then. This is going to be hard for you. Okay, why is Polen Capital's EM strategy in 1 minute different from others in the market?
The difference is that there are a lot of good managers in the marketplace. What we say to clients is we do very, very clearly what we say we do. So we manage with 4 tenants. We find portfolios of the best companies we can find. We build concentrated portfolios. We think long term, and we're happy to be different. All those 4 things done together, we think is quite unique in the marketplace. And people can see that if they look at the outcomes of the portfolio in terms of the companies we invest in, the countries we invest in, and the experience we give our investors.
Okay, another very quick question for you. What type of environments does your strategy underperform in?
I would generally...
Sorry, you could say when it performs.
It's fine, I have to talk about it. Like, basically, I said before, we invest, we don't speculate. There are parts and times in the market where speculation is ripe. When people buy loss-making companies with no business model, when people are piling into crypto, things like that. And you see huge swings to the upside in markets. Generally, those type of conditions are ones where I would expect our funds to underperform, because we're not taking excessive risk. So when the market rewards excessive risk, a fund like ours is not going to outperform in that type of environment. The converse of that is that when everyone realizes, yikes, that was quite a lot of risk, maybe we need to pull back on that risk barrier, I'd be very surprised if our fund did not significantly outperform, because we're not taking the risk of investing in highly speculative businesses, and therefore those businesses are not the ones that are being sold. So the journey is much, much more steady. Over time, we think investing in the best businesses is less volatile, and also we think has potential to outperform the market over a long period of time.
So, and another quick question. I'm just firing these questions and really testing you on Polen Capital, really. I know that when we spoke, and I think this may kind of tie in with this, which is why I've thrown this question in here, is that we talked about yours being kind of a sleep easy. I put it in inverted commas. So anyone listening to this, don't take this as, oh, you can invest in it and nothing will happen. So like sleep easy, safe strategy, kind of within emerging markets. What does that mean in practice? Is that about the sort of steady, thoughtful investing kind of approach? Is that what you mean by that?
Yeah, I think it means that there's unlikely to be a market condition where you see a big sell-off in the markets and our fund would perform worse in that environment. Like, obviously it's possible, but again, we're investing in very durable businesses that, I mean, it's all about the companies, right? We invest in companies that theoretically, or we expect to be able to continue to deliver strong economic performance in strong economic conditions and weak economic conditions. And therefore, the prospects of the companies don't move to an extreme extent, depending on the macroeconomic environment. And so I suppose why investors could perhaps expect our portfolio to be a slightly less worrisome or volatile journey is because those changes in that delta on the macro, like for example in Brazil, right? Brazil goes through periods of this person won the election, that person won the election, interest rates skyrocket, inflation skyrockets, comes down again. Some companies are hugely volatile in that. The ones we invest in are the ones that we think can do well kind of through that environment, and we don't have to overly worry about exactly what's going on. And we think that's the experience that we can offer to investors as well.
So 2 more questions. I'm going to wrap into one about Poland, and then I'm going to kind of wrap this all up. Some people may or they may not know, but you recently, I say recently, it may not be that recent now, but recently you took over or taken on some of the Somerset Capital strategies. And the 2 questions that I've got from there is that I guess it's understanding what that actually means, because I'm aware of Somerset Capital. I've kind of in previous jobs I've used them, so it'd be interesting to know what your plans are going forward. And I think when we sort of spoke, and you can correct me, but I know you referred to your team as kind of a world-class team. And it'd be really nice to, yeah, sorry, I've really thrown you on a bus on this one. So I think what would be nice kind of when we're looking at this section around Poland really is to talk about just briefly kind of where you're changing in terms of the Somerset Capital. And I guess just sort of maybe just explaining how you've got people from different firms, I guess, is where that team has come together. And if you can kind of wrap that up in 30 seconds, that would be 30? Amazing.
All right. Yeah. God, referring to our team as world class, I'm embarrassed if I said that. I'm very English and I never would use such hyperbole. But no, I'm very proud of our team. I think we've been very fortunate that we've been able to attract a really high caliber group to Poland. It's been a tough time to raise money and raise client interest in emerging markets in recent years, although that is changing. But it's been a very good time actually to acquire talent and offer some of the best talent in the market home, because many of the managers have found times tough in recent years. So we've got people from First State, we've got someone from RSA, we've got someone from LGEM, formerly Lloyd George, and we've got some people from Somerset as well. As you mentioned, George, Somerset has been a fantastic manager over the last 15 years, one of the kind of pedigree names in emerging market over the last 2 decades, really. But some people on the listening will know that the company essentially decided to wind up about 1.5 years ago now. And I think what we were able to do was to offer some of the team and also some of the clients a home at Polen in a strategy that was very congruent and looking to achieve the same kind of investment outcomes using the same philosophy and framework as had been proven so successfully at Somerset. So we thought it was a good opportunity for Somerset's clients, for some of Somerset's team, and a good match for them to come to Poland.
That's really good. And I think that's really nice, is that I know that you're talking about kind of a single fund going forward, and I've kind of, I hope that people who've been listening to this have kind of got a flavour for how you approach and how you look at things. I'm going to ask you kind of belief and conviction is where this has come by. I'm going to ask you again a couple of real quick fire, and I don't know if they are going to be quick fire, but I hope they are, because on the basis of where I said who inspired you, I'm going to then ask you, and you literally have 30 seconds to tell me, do you have a book or something that has had a lasting impact on your thinking or approach?
Yeah, there's many books. I like the Warren Buffett Way by Robert Hackstrom. But the one I will reference here is what I think is the best investment book, which is actually one called The Outsiders, which is all about how various different CEOs manage to create value through effective and thoughtful and efficient capital allocation. And it's really about the decisions that companies make, how to invest the profits they earn into reinvesting in their business or returning it to shareholders is a key determinant of value creation over time. And I think it does a very, very good job of explaining how that works.
And then hopefully this is a really easy one. Do you personally invest in the strategy that you manage?
Absolutely.
And why?
Well, I kind of already mentioned that I am all in on this at the moment. I haven't always been all in, but at the moment I find the opportunity so compelling. So my pension's in, my SIP is in, and my personal allocations are also invested in emerging markets and our funds.
So I'm going to ask you in a minute, I'm going to give you a 1 minute pitch on why EM, but you could have had this at the start, but now I've put this at the end. Okay.
Yeah.
So can you share, or you're happy to share? Now, obviously we're English and we don't like to share things. So can you share something surprising or little known about yourself that you're prepared to share to the world?
Yeah, I mean, look, nothing particularly interesting about me, I would argue, but I think one thing that I would share that I'm excited about coming up in the current year is, look, I'm a big cricket fan, George. I'm a big football fan, I'm a big golf fan, and I'm a big tennis fan, but I'm also a cricket fan. And I have followed the England cricket team around the world, so some very interesting places. And of the test playing nations, I think I've been to all of them, apart from Pakistan and Zimbabwe. But I've been to Bangladesh, I've been to Sri Lanka, I've been to India, I've been to Australia, New Zealand, South Africa, West Indies, maybe a few others I can't remember. But this year's the Ashes. So I'm going to try and work out how I can get myself down, maybe to that first test in Perth, which is towards the end of November. I'm kind of keen to go down there. It's a new ground, haven't been to before. And you know what? I think England have got a chance this time. So that's one of the things that I'm excited about as we come towards the end of the year.
I think that's great to hear that, because I grew up, my dad used to play cricket. He was like village cricket. So I kind of grew up on that. And I think the England cricket team is it's very different. The 5-day game is very different to what we were used to. Certainly in my age, where I remember sort of Boycott, who used to play for about 5 days and score about 10 runs, so it's very unfair.
I love a bit of Jeffrey. Who doesn't love a bit of Jeffrey?
So okay, so the final pitch. Why? And you've only got 1 minute, okay? So you can't. It's like supermarket sweep.
Yeah.
Why should someone consider emerging markets as part of a diversified portfolio today? If you could wrap up everything you've said.
Absolutely. I think I would just, I've kind of referenced it a lot on the call, but as I said, I just think as someone that's in the market right now, we've rarely seen the opportunity so compelling, in our opinion. And I would encourage kind of anyone that is interested in this idea to go and do their own work and have a look at what I'm saying. Have a look at the fact that emerging market valuations are at record lows relative to history and relative to the rich world. The economic fundamentals remain incredibly strong. There are some companies that are delivering exceptional earnings growth that I believe belong in the conversation to be amongst the best businesses in the world, that themselves are trading at very, very low multiples and are under-owned by the global asset market community. And I think that collection of facts, I would say they're facts, is exactly what one is looking for when one is thinking about new ideas to allocate to.
That's great. That's great. I was just thinking as you were going through that, I was thinking, do you know what?
I got to invest is what you were thinking, George.
Yeah, I don't put my money in this. No, I was thinking more. Yeah. I was thinking more like we could just keep on talking. We could talk forever around this. And I think, I remember when in my previous job, we had quite a high allocation to emerging markets. And when I think about it, it was like 3 years ago. really was probably too early for us to have gone into there. It was probably a very brave move, and didn't really pay off for the period that we were in there. But I think you've been great because you've covered so much. You've been really insightful. I've enjoyed that kind of thought behind diversification, and kind of down to how many holdings you have, through to how you navigate emerging markets. And I think also just kind of you get a flavor of how you operate as a team. And I think also bringing together different people from different firms. I say I probably interpreted what you said from world class. Probably I need to interpret.
I reckon I said
English.
very good, and you were like, "Oh, actually," you looked at the page and thought, "Actually, this looks excellent," and you wrote down world class. I mean, I might have said world class. I can take that out if I do, though. Far too English for that. Although I do work for an American firm.
So anyone heard that comment about world class? It wasn't Damian. It was me interpreting his words. And so anyone kind of listening to this, I will put a link onto Polen Capital so you can look at their website, and I will also mention about the book. And as I always say, please like, subscribe, share, because that helps us to grow. And I just want to sort of really thank Damian for coming along, because it's great, from the conversation we had in a cafe to being able to kind of bring this to life. I hope that, so I hope people have enjoyed it. So thank you, Damian, for joining us today.
Yeah, thank you, George. It's been an interesting conversation. I love talking about an asset class that I'm very passionate about, and I really think is, it's fascinating to talk about all the different areas, and you've asked some very thoughtful questions, and I've enjoyed talking about them. So thanks for the time, and appreciate all the listeners on the line.
Thank you.